Keith's first idea is the VanEck Oil Services ETF, OIH. I mean, that looks like a fairly leveraged play on an oil recovery.
Yeah, so I mentioned that we are just starting to leg back into oil, and this is the one we just literally bought like a week and a half, 2 weeks ago. We leg in, and anybody that reads my blog, valuetrend.ca, and you'll know that I believe in the principles of legging in rather than just plunging into any position. You gotta, see how it's progressing. So we started buying into this position. This is not really showing a good example of why I like this sector, but maybe I'm gonna. Okay, this is a shorter-term chart. That's why. So, it is in the near term, and on the daily chart, it's pulling back a bit. But if we kind of looked at the really big picture, there's a really strong support level that goes back 5 years that we're attempting to buy off of. So, and we like oil in general as a 3 to 6 month trade from here. So we're just, as I said, we're just starting to leg in, and this one I think is going to be, one of the better positions if oil moves.
Canadian Western Bank is your next idea.
Okay, well, I mentioned at the beginning of the show, there's only 2 banks I own, and one was TD that we talked about earlier, and this is the other one. And it's because it doesn't look like the rest of the Canadian banks. They have a different business model because they're in a different, they have a lot of, obviously, energy producers and stuff that go to them for their financing. Craig likes it fundamentally, and I'm just going to see, there's the chart. You can see why I like it technically. One of these rounded looking things with the with the neckline breakout. I think it's got tons of upside. I mean, I honestly believe that this stock could get very close to $40. So we'll see, but we're in on the trade. We've made some money on it so far, and we're sticking with it until something negative happens to the chart.
And then finally, SNC Lavalin, ATRL is now the new symbol.
Yeah, that's the symbol always messes me up because it used to be SNC.
Yeah. Well, they're changing their names to Atkins Realis.
Oh, is that right?
Yeah.
Okay, so I have to get used to that. So we're buying. It's in an uptrend. It's kind of consolidating, a little bit of a triangle. So this is something I haven't talked on the show today about, but sometimes you get these consolidations, and so long as they're not making lower lows, it's just a consolidation. You get kind of a tightening pattern where the stock starts off with big swings and it gets tighter and tighter and tighter, and often they break out. So we're picking up 2% at a time. We usually leg into stocks, and so we just started buying into SNC, and we're hopeful that it'll break out of the triangle and go up.
Topic number 1, Cogeco Communications. Well, Rogers just finally sold its shares in that company.
Yep, and that's what brought the share price down into the low 50s. So it's currently yielding 6.6%. Compared to the other telcos, they're growing their dividend at 10% a year compared to 5% for the others. Why? Because they're generating better cash flows. The knock against them is that they're in the United States. U.S. consumers are much more fickle than Canadian and less loyal, and will hop from one to the other for the strategic or the cheap deals that are going on. So the biggest issue for them is that move to streaming services from usual fiber or broadband. However, they've been very good at what they've been doing. They've been picking up some market share in the areas where they've purchased in the United States, so they can take on AT&T and Verizon head-to-head. And with a 6.6% yield, you only need the price to go up 2 or 3% to make your 10% total return. So, and if the dividend's rising 10% a year within 5 years, you could have a 10% yield alone. So I think this is a very strong buy, given that it was as high as 82 a year ago. So again, like the dogs of the Dow, we just want a dollar cost average on the ones that have come down the most, where the yields are high, and if interest rates are going lower, then the stock price should go higher.
Your next idea is Atrion. It's a maker of niche medical products.
Yep, so if you think of jumping out of a falling aircraft and you get that life vest on You have to pull the tab. The tab is what Atrion makes. They also make tubes for heart surgeries, lens cases for contact lenses, all the things that the pharmaceutical and medical device companies don't want to manufacture. They're that small. The stock fell in the last year by quite a bit because they didn't lose any customers, but with interest rates rising, corporations did not restock. They've just been working through their inventory. So the case will be that when they have to start buying inventory, Atrion can raise prices and start a renewal back to higher revenues and earnings. The stock's trading at roughly 20 times earnings, which is the lowest it's been in a long time. And the dividend yield you're getting is about 2.5% for a stock, where they've been averaging about a 10% dividend increase per year, although it didn't happen this year because revenues were down.
Okay. Yeah, that stock, wow, it's taken a hit this year, Atrion, down about 39% in 2023.
But they haven't lost customers. They're just waiting for their customers to restock again. And that's happened right across the medical device industry.
Okay.
So people can't go without their hips and knees forever before they have to start to pony up with the cash. And hospitals are now starting to spend on their 2024 budgets. So it's coming.
And then your final idea, Jardine Matheson Holdings, kind of a legacy of empire, I guess, based in Hong Kong.
Yeah, it goes all the way back to the 1600s in the opium trade. The one thing that people don't like about the company is the Chinese exposure, but it's only 25% of revenues. Their biggest exposure is in Indonesia. So they're stuck with the Indonesian rupee as their currency, but they have to show their profits in US dollars. So in the last year, the rupee's gone down and come back, but it hasn't been shown in their earnings, so that there's another 12% coming in the expected earnings when they announce again. So this goes along with the global theory that if interest rates in the US fall, US dollar falls, then Jardine Matheson's earnings should start to rise again. And they're a conglomerate as a proxy for our Southeast Asia investments. And they've been growing the dividend at roughly 6 to 10%. If the earnings grow 10%, you can pretty much imply that the dividend's going up another 10%. So you get 5.5%, so it's like a bond proxy, and just waiting for the US dollar to fall and or the economies in Southeast Asia start to pick up again.
Apparently in 1832, William Jardine and James Matheson, two Scots, established this trading company in East Asia. And as you say, they were involved in the import of opium, yeah. Also the export of teas.
Yes, and now it's just Mandarin Oriental Hotel, Maxim's restaurants. They've got franchises of IKEA and Starbucks, the leading Mercedes and BMW dealerships throughout Southeast Asia. So their tentacles are everywhere. And it's a well-run company, not overly leveraged. They got lots of room to acquire if they want to.
We better leave it there. Thank you very much indeed.
My pleasure. And Merry Christmas to you, Andy, and to your family.
Thank you very much. David, same to you. First idea, Franco-Nevada, the precious metal streaming giant.
Yes, Andrew, this is the company that pioneered the concept of resource and royalty streaming under the chairman emeritus about 40 years ago. And it is the biggest and the best of breed in that category. We like the business model because it affords exposure to the commodity price and upside optionality to more reserve and more resource discovery as the operator of the mines explores brownfield areas adjacent to the mines they're building. And it insulates Franco-Nevada shareholders from the operating and capital costs overruns that are endemic to mining. This is a company that is well diversified by geography and by operator. It's got a bit of commodity exposure that's non-gold in the mix, silver, some other precious metals, and oil and gas, notably. We think it's timely right now, and perhaps controversially so, because the stock price has pulled back a lot since the summer. And that's because their biggest royalty interest is in the Cobre Panama mine, operated by First Quantum Minerals in Panama. which has rather controversially been nationalized by the Panamanian
shut
government.
down anyway.
Shut down,
Yeah.
So that royalty accounts for about 22% of their net asset value, and the market has shaved about 30% off the shares. So I think there's a good margin of safety in the stock at this level. But more importantly, after having spoken with the company and looked at all the documents from First Quantum Minerals, we do think that they'll prevail and their royalty interests will be upheld in international arbitration, because historically that is what happens. The courts find in favor of the operator most of the time. So it's in the doghouse and a little bit under a dark cloud for now, but that creates a contrarian opportunity in our opinion.
Your next idea is McKesson, the giant drug distributor and also owner of Rexall here in Canada.
Yeah, that's right. I'm glad you pointed that out, because McKesson is perhaps not a household name in Canada, but Rexall certainly is. That's a smaller business for them. They acquired it from the Katz Group about 8 years ago. But their core business is as an intermediary or a wholesaler drug distributor in the United States. And in effect, what they do is they negotiate bulk purchases of branded and generic drugs from their manufacturers, move them to their warehouses, and then finally move them onto the end point of sale, whether that's a retail pharmacy or a hospital, long-term care home or clinic or what have you. It is a very low margin business, only about a 1.5% net margin, but they're very efficient. They turn the inventory a lot such that they earn a high return on shareholders' equity. It's a very stable and non-cyclical business. It is an oligopoly with the top 3 players having a combined 90% market share. It's non-discretionary. When you need the medicine, you need the medicine. And the stock is re-rated upwards. The chart looks quite nice, trending upwards and to the right, which is what we like to see. But it's still trading at an undemanding multiple of about 15.5 times earnings. We own it in our dividend growers mandate. It has grown its dividend at a 10% compound rate over the last decade. And we think it will be well positioned to continue doing that going forward.
I'm not sure if you're following that story with Neighbourly Pharmacy. The private equity firm that wants to buy out the public shareholders has cut the price to $18.50. And the reason I mention it is I saw one analyst report suggesting that McKesson could be interested in NBLY.
Oh, that's an interesting angle. I would be a little surprised to see that, but I will concede I haven't followed that takeover situation super closely.
And the drawback there is apparently that controlling shareholder said, nope, this is the only deal we're interested in. So, yeah. And then finally, Uber obviously has changed the way we get around.
Well, yeah, that's right. And I'm reminded of the viewer who called asking about Google. And I think Uber now occupies the same sort of mind space that Google does. We use Uber as a verb. I'm going to Uber to the office after this, or Uber home after this. And so, that really speaks to the fact that it has become synonymous with ride sharing. There's 131 million monthly active users. Lyft is sort of a Me Too copycat in this category. But Uber has really built a dominant and scalable platform with strong network effects and has expanded into adjacent areas like freight, and food delivery. And so the network effect speaks to the fact that the more connected drivers and riders they have, or food orderers and food deliverers, the more valuable the network becomes to both parties. Financially speaking, it has turned the corner. It bled a lot of red ink for a number of years prior to the IPO, post the IPO, but is poised to be in the black this year, and profits are expected to triple next year and continue growing very dynamically looking out into 2025. This stock actually was added to the S&P 500. We were speaking earlier off the air about another company that was added to the index a few years ago. This one we think will fare better than Tesla, which has disappointed since being added to the S&P 500. And so we look at this company and we own it in our momentum mandate. And we look at it on the surface, again, like a lot of the companies that are disruptive innovators poised to change everything, they look expensive on the surface. But because they're so dynamic and growing so quickly, they grow into their valuation. So if you look out at, for instance, 2025 forecasted earnings, the valuation looks much less demanding at sub 30 times earnings. So this is a game changer. It's become a verb and a fairly new addition to our momentum portfolios here.
Brian, thank you very much indeed.
Great to be here, Andrew.
Ryan Madden, if we don't talk to you before the holiday, have a wonderful break and a great 2024.
And all the best to you and all the viewers as well. Thank you.
First idea, Alphabet.
So we've held this is one of our core technology companies. And even though Alphabet has done well, we think there's still a lot of future potential for this company. It's going to be a leading player, I think, in generative AI. They've got tools. They've announced, Gemini is their large language model they just announced a couple of days ago. Bard is their chat box that competes with
Microsoft's. And I can't, Bing. Well, I guess Bing AI.
No, anyways, whatever. I just have a brain freeze there. But,
sure.
But we do think that, obviously leading search engines, so it's all about online advertising. And they're going to have all these AI-generated tools to make it more efficient. And as well, they have also these other, YouTube is one of their divisions as well. They're seeing good double-digit growth on ads now for those divisions. And this company has a lot of cash, $120 billion on their balance sheet, so they can fund investment in R&D. And as well, I think of some of the other large cap tech stocks, it's kind of lagged in terms of its cost reduction focus. They did lay off about 2% of their workforce last year, but there is talk that they're going to really refocus more about restructuring and making themselves more efficient through the use of AI. So I do think that there's actually potential for operating margin improvement. So we were thinking of ChatGPTs, Microsoft's chat box.
Sure.
Yeah,
okay.
Sorry.
So
we do like Alphabet, even though it's done well this year. We still think that you can buy it here at these levels.
Okay. We've now got Pembina Pipeline. Why would this be an energy services name you like?
Yeah, so we touched on Enbridge earlier. So Pembina is the other energy infrastructure name we own in our client portfolios. Pembina we like because we actually they're very well diversified across all the different commodities, natural gas, crude oil, natural gas liquids. Their facilities and pipelines are well positioned. We like the latest transaction they did. They announced they bought the other 50% of Alliance Pipeline from Enbridge, and they're the operator of Alliance, so it's very little integration risk. And they also bought Enbridge's interest in Osable, which is midstream operations. So I think that it's going to be very creative. They got it at a pretty attractive price. They see some synergies, operating synergies, cost synergies. And so, it gives you a yield of 6%. We think that dividend will probably go up a little bit every year, not probably kind of the mid-single-digit range. 6% yield, very attractive. Its businesses, about 70% is take-or-pay or cost of service, so it's very reliable cash flows as well.
And there's been talk that they might take a look at the Trans Mountain Pipeline, I think.
Potentially, but that's kind of out there. And they did an equity issue to fund that latest transaction. And what was encouraging, it was then at a 7% discount, the equity issue. And the stock has actually recovered most of that decline. So which means that the market, likes that transaction and was relatively well received.
And finally, Thermo Fisher Scientific.
Yeah, so this name we started buying in June of this year. And the stock price has not really done too much, which is why it's now, again, a top pick. So they provide all the kind of the picks and shovels, all the products and services to the healthcare industry. Customers are biotech companies, pharmaceuticals, anybody that wants to run a lab. So Thermo did very well during COVID because a lot of their products and services were used in vaccine production. And so, they generated a lot of cash flow and income, which they've redeployed, bought some assets into their own R&D, but it's been a headwind for revenue and profits. Now, I think, going forward, this past year, they had to actually reduce guidance a couple of times, which is very unusual for this company, and really because of two reasons. One, weakness in China. We know that the Chinese economy just has not recovered as everyone thought. And secondly, just general caution in spending from pharmaceutical companies, biotech companies, lack of investment from potential investors because everyone was concerned about interest rates. We do think that, and there was some inventory destocking because a lot of the pharmaceutical companies, biotech companies, they bought during COVID when there was lack of supply. They bought maybe more than what they needed. So there was some inventory destocking. We think that's largely behind us. Generally, we like the long-term fundamentals of the healthcare industry, and we think Thermo is going to participate along with new blockbuster drugs as well as pipelines that pharmaceutical companies have as they develop them.
I'm just looking at the range of stuff they have for DNA, genomic DNA extraction. And that
they provide everything, like a very vast array of capabilities.
Yeah, you can get us. They have a DNA 70 years of breakthroughs. You can get a special T-shirt if you order enough stuff. Anyway, thanks very much, Christine.
Thanks, Andy.
Okay, on this special edition of Market Call, we've got a special top pick segment where each of our three great guests has come to the table with one major idea. And we're going to start with Earl Davis, who was talking before the break about a few different fixed income ideas. But in the telecom sector, Rogers Corporate Bonds is at the top of the list right now.
Yeah, we absolutely love Rogers Corporate Bonds. We're looking at the 20 to 30 maturity. You know what? Their recent Spectrum auction came in half price, basically billions of savings, which supports the balance sheet, the savings to the sale of Cogeco to Cogeco. And it looks great from a financials perspective. It's essentially an essential as well, too. And hey, they missed out on Shohei, so that's a $700 million savings right there. So all good. We like Rogers Corporate Bonds.
All right. Moving from bonds and baseball to Brienne Gardner's top pick, which is Capital Power.
Yes. Also, I just would like to note my last year's top pick was Costco,
Which is
lights
done
out.
Very well. Yeah, including a big special dividend. There you go.
So my pick for 2024 is CPX Capital Power trade on the TSX, largest, power producing. One of the largest. Currently is doing an acquisition of 2 natural gas companies out of the U.S. worth $1 billion. They have $9 billion in assets right now. So this will actually bring them up to the 5th largest in North America, which is great for the company. They have a 6.6% dividend yield, which is, I think, steady, and you're still collecting income from the stock. It's down about 15% year to date. So I think a great valuation, good entry point here. Again, when interest rates start to come down, I think we'll see utilities start to go up. So for us, we see a lot of upside. I think price target on the street is around that $48. So, significant growth, and we see it could carry into 2024.
Okay. Speaking of income, John Zechner, we talked earlier about the pipeline sector. On the fixed income side, we talked about Pembina. On the stock side, you like Pembina?
Yeah, I love it when the bond guys like something that I like. I like the Rogers. We like the stock, and then Earl likes the Pembina bonds. I like Pembina stock. A little fits into what we're looking for, some defensibility in the market, not much economic sensitivity in the name, high dividend yield. There's some growth in there as well. The acquisition they've done recently of some of the Enbridge assets is going to be as well as already financed out there, and we'll consolidate them a little bit more. So I think it's a great play.
Okay, and then just big picture, final thoughts from all of you. Brienne, what are you thinking about? What might keep you up at night heading into 2024?
Yeah, I think we're thinking a lot of people too, right? After seeing pretty much 8 weeks of consecutive market rally, people are wondering, can this still sustain through 2024? So if you look at the historic data too, after we've seen this, historically the markets are up 1 year later by an average of 10%. Obviously, there's a lot of moving factors and data that we're monitoring, decreasing inflation, GDP leveling off. We still see a mild recession happening, likely probably Q1, Q2. Our expectations are interest rates are going to be coming down by 4 cuts next year. And again, I think there's going to be a little bit of noise with the U.S. election, but historically markets are up in the 4th year, in election year, 85% of the time. Again, more bullish than bearish. So I think it's going to be a year of active management, stock picking. We're going to see rotation from what has led to a little bit more broader participation in the equity market, but I do think it's going to be a great year for the markets.
Earl, I remember last year we were talking about the interest rate outlook heading into 2023. You spent a lot of time thinking about this. What are you thinking on the macro side heading into next year?
I actually think macro will be boring. It's going to be about active management on the credit side. And the reason why we think macro will be boring, interest rates will largely be stuck in the same range that it was for 2023, not making new highs or lows. And we're better buyers now of duration on any backups because we believe it'll be sustained. One thing of note, though, we think what keeps us up at night is a good thing. We actually think there could be economic growth surprises just because financial conditions have eased so much in the past 2 months. 150 basis points from overnight, basically, because that's what the market's discounting, to 30-year bonds. That's a lot of big tailwind for the markets, and we think there's an upside surprise there.
Our final 30 seconds to you, John Zechner.
No complaints on the stock market this year, clearly, but the macro call has been tough, and everyone talks about a hard landing, soft landing. Forget it. You know what I think we're getting? We're getting a muddy landing, and which I mean is I think we're going to slow down. We have to repeal the laws of economics. We're going to slow down. We're not going to lift off again for a period of time. I think a sustained period of low economic growth, inflation will come down, but as Brienne said, that'll probably be good for markets. because interest rates will stay low. So yeah, more of the same, but maybe we got ahead of ourselves a little bit short term for stocks. So we'll lean into that trade a bit.
Well, nothing muddy about the conversation. A lot of clear ideas. Great to have everybody back. Thank you so much for being here, Brianne and John and Earl. And we thank you so much for phoning us and sending us your emails. And we wish you all the best in your road ahead. And we'll see you next time.